A microscopic stress fracture in a steel beam doesn't just sit there. Under pressure, that structural shift triggers a violent, immediate collapse. In the financial markets, options contracts behave exactly the same way. A seemingly harmless $1 drop in a stock's price can instantly wipe out 50% of an options premium. To an untrained observer watching these numbers flash red and green on a screen, this price action looks completely random. It feels like pure chaos, or worse, blind gambling. But underneath that surface noise lies the Black-Scholes model. This mathematical framework breaks down the erratic movement of options into 5 variables, known as the option Greeks. These Greeks act as the physical laws of the market. Understanding them is how professionals transition from placing blind bets on unpredictable price shifts to executing calculated, engineered risk management. The first law of the system is speed, measured by delta. Delta tells you exactly how much your option's price will change if the underlying stock moves by a single dollar. It also dictates direction. Call options, which profit when a stock rises, possess a positive delta. Put options, which profit on the way down, operate on a negative delta. Let's look at the actual math in this table. If a stock increases from $100 to $101, an option with a delta of 0.7 will see its premium increase by exactly 70 cents. Options that are already in the money, meaning they currently hold real intrinsic value, carry a naturally higher delta. Therefore, they react with greater sensitivity to the underlying stock's movement, often moving almost dollar for dollar. By reading the delta, a trader immediately mathematically quantifies their exact directional risk, along with the precise velocity of their potential profit or loss. But speed rarely stays constant. That brings us to gamma, which represents acceleration. Gamma is the invisible force that pushes or pulls on the delta itself. This diagram shows how the two metrics interact. Gamma determines how much your delta speed will increase for the next dollar move. Notice the curve forms a sharp, centralized spike at the money threshold, becoming highly concentrated near expiration. Because of this concentration, gamma warns traders when their positions are about to become highly unstable. It acts as a crucial gauge for the physical stability of an option's price. While delta and gamma track the actual trajectory of a stock, an option's price is also battered by environmental turbulence. That force is vega. Think of vega like a massive storm system rapidly expanding and growing more turbulent, without ever actually moving an inch across the horizon. Vega measures implied volatility. When market fear and panic rise, this expected turbulence artificially inflates the option's premium value. This area chart illustrates vega's reach. You can see a massive elevated area for long-term expiries, meaning vega acts as a heavy multiplier for distant uncertainties. For short-term contracts, that influence shrinks down to nearly zero. Because vega drives value independently of the stock's actual movement, a trader can generate substantial profit from pure market panic, even if the asset never moves. Every option fights against the clock. Imagine a glowing block of ice under a harsh spotlight, losing its physical mass with every passing second. This is theta. It represents time decay, the absolute, unavoidable depreciation of an option's value simply because time is passing. This line graph tracks a typical 90-day timeline. The decay is not a linear burn. It starts as a gradual slope. Entering the final 30 days, the theta decay rate plunges dramatically into a steep, aggressive drop, rapidly vaporizing value. Alongside theta, long-term options face another subtle drag known as rho. Rho tracks the macroeconomic cost of carrying an asset, tying the option's value to shifts in national interest rates. Together, theta and rho represent the relentless friction of reality. This mathematical constant makes theta the option buyer's greatest enemy and the writer's best friend. Delta, gamma, vega, and theta do not operate in isolation. They are simultaneous forces, constantly pushing and pulling on a single price tag at the exact same time. When you view the market through this equation, your focus shifts away from blindly guessing whether a stock will go up or down tomorrow. Instead, professionals actively combine these metrics. They mathematically neutralize the risks they want to avoid, while maximizing their exposure to the specific variables they want to exploit. This data allows a trader to structure a portfolio that offsets the daily cost of time decay against the potential gains of a sudden volatility spike or price move. Understanding the Greeks reveals the mechanical drivers of an option's price. It turns the guesswork of market movement into a series of quantifiable, manageable risks.